When you're trying to buy properties like shopping centers, there is something called an acquisitions and leasing paradox. If the acquisitions team doesn't underwrite the deal so that the lease up happens a little bit quicker than average, or achieve rents that are a little bit higher than average or a little bit harder to get, or underwrite concessions that are a little bit less than the market, then a lot of times you don't get to acquire the property because it is an ultra competitive process. And there is a ton of cash out there chasing commercial real estate, especially shopping centers. And those leasing departments or the heads of leasing, they might err on the side of being conservative, scheduling out lease up that's a little bit easier to achieve, or maybe penciling in rents that are a little bit easier to reach, or maybe giving a little bit more concessions so that you don't go over budget. All of that so that when you create the budget, you're able to hit it. But the part that I think gets missed is that if you take such a conservative approach on leasing and it doesn't match your initial acquisitions underwriting, then you underperform for the investors in terms of both your annual yield and also your internal rate of return. And that's what they're counting on. If you tell an investor that the deal is a 14% IRR and a 10% annual yield, and you don't execute on that business plan, then you don't just miss the goal, but you have some serious egg on your face. In commercial real estate, you're dealing with investors, and those investors invest in other things other than CRE. They have the option to invest in stocks and bonds and art and commodities, even in cryptocurrency, but they're deciding to invest in commercial real estate because of the promise of a specific result. Today, I'm going to explain and illustrate the first principles of commercial real estate value creation, as well as the dynamic between leasing and acquisitions. My name is Chen. I am president of Saglo Companies. We own a portfolio of shopping centers across the Southeast, and I have a mission to try to spread the word of our industry, to try to bring in at least 100 new students or newbies into our industry that might not have known about it otherwise. So why do investors put some of their money into commercial real estate? Sure, commercial real estate has unique features like being able to depreciate the asset and apply it against your income on your tax returns. And also, it is an inflation hedge. But in reality, most investors look at the two key outputs. So you have cash on cash, which is also yield, which is also your dividends. It's all the same thing. That's one side of the value creation. And then your IRR, which is your internal rate of return, which is how quickly can your equity increase. And you do that usually with two ways. One is by the appreciation of the asset itself. And also, if you have some debt on the property, it's the principal pay down as well. So over the years, as your property appreciates, because maybe the income goes up or your cap rate profile goes down, and you've been paying down principal, then your equity continues to increase from both sides, from having more principal because you paid it down on the debt side, so now it's on your balance sheet, and then the appreciation of the asset. And just to give you a quick example, if your average yield is 10% annual yield over a 10-year period on average, and your internal rate of return is a 14% over 10 years, then the difference, which is that 4%, is essentially your appreciation. And if you told your investors that's the type of yield and IRR that they should expect, and you don't hit it, or if you miss it very widely, then a lot of times that capital starts to go elsewhere. Acquisitions teams are always thinking, how do I underwrite the lease up of this deal so that I can achieve the fastest lease up possible, meaning I lease up the vacancies the quickest amount of time possible, at the highest rents possible, with the fewest concessions possible, and have a tenant mix that will garner the lowest cap rates possible. How do I get all those things happening at the same time? And most of these analysts and acquisitions teams, they have never done leasing themselves firsthand, and they rely on the executives of the leasing department to give them guidance on how they should underwrite the lease up. And that's actually one of the reasons why I always tell students, even if they want to go straight into acquisitions or be an analyst, that a really good place to start would be leasing, and to do that for a couple of years so that they really understand the income side of that value equation and can underwrite a lot more accurately. And those heads of leasing might be thinking to themselves, well, if I tell that acquisitions executive something a little too aggressive, maybe rent's a little too high or lease up a little too fast, then I'm going to be stuck with it if we get the deal. So maybe I'll tell them some numbers or some statistics that are a little bit easier to reach. Maybe they'll tell them a rent that's a softball rent, or maybe that it's concessions that are just safe because the tenant improvement allowance is high enough that for sure I'm going to come in below that. Or the rent, you don't want to be the highest rent in the market because that just wouldn't make sense maybe. And I've worked on a lot of properties that were the highest rent in the market, and it's a lot of times there is justification for that. But if you underwrite so conservatively, I can tell you that it's possible that you make 100 offers to buy different properties and 0 of those offers get accepted. Because ultimately what gives you the right to win the deal if you're not amazing at leasing, right? And when I say win the deal, it's because when you're dealing with these larger shopping center transactions that are $20 million, $30 million, the process of that is usually a blind bid process. They don't tell you what the offer price is. You underwrite the property and you bid what the price is that you think it's worth, and then the seller has a selection process and awards the deal to somebody. So one of the bidders wins that opportunity to buy the property. That's just how it works. So that is where a comprehensive strategy really comes into play. And that can only occur if both leasing and acquisitions have a really firm grasp on the first principles of value creation of commercial real estate. Think of it this way. Instead of asking yourself, hey, what kind of rent can I get for that space or how fast I can lease it, change your mindset. Instead, maybe think, well, the rents are $20 a square foot right now. Let me set a goal for $40 a square foot. The property might be 75% leased. Maybe my goal is 100% leased in 1 year. Maybe there's some spaces that have been vacant for 10 years or 5 years, and I'm going to underwrite that I lease those up in the first year or two. And then you ask yourself with the team, with the operations department, leasing department, acquisitions department, so if I set these really aggressive goals, let's just make believe, let's pretend, double the rent, base rent, get the occupancy to 100% in record time, lease space that have not been leased for maybe a decade. What would have to happen to do that? Is it within the realm of possibility? What strategy would we have to employ to get there? And really start thinking about it. Once you set the stake way ahead, now everyone's brain has to be working and thinking together, well, if I were to do that, how could I do that? See, that's a different mindset than saying, I have this property and it's 85% leased at $23 a square foot average base rents. How fast can you lease it up, and what kind of market leasing assumption rents should I put in here, and what kind of concessions should I be giving? So that's one way to do it. But what I'm saying is put the stake way out in front and think multi-departments. Can I even get there? Can I get there? Because if you can, the payoff is enormous and it's huge and it's worth it. And more importantly, you actually get the deal because it's an ultra competitive process. You might be bidding against 20 other shopping center owners just like you that want to buy the property, that want to own that asset. But what gives you the right to be awarded that deal to buy? As a leasing agent, you are in charge of 2 pieces of the economic engine of shopping centers: the gross revenue part of the net operating income formula, as well as the cap rate part of the value formula. The first principles of commercial real estate is that the value of a property is the NOI, or the net operating income of the property, divided by the cap rate. The NOI of the property is the gross revenue of the property minus the operating expenses. The higher the gross revenue, meaning that the higher the rent and the higher the occupancy rate, the more NOI you have, and that's measured quarterly. The cap rate is the perceived risk of the property. It includes the quality of the tenants, the credit rating, the financial strength, how good of an operator that tenant is. And when I say tenants for shopping centers, those are businesses. And a lot of times you can measure how well that they do by their store sales and also how much traffic that they generate inside of their store. And as a tangent, that is a reason why we often really push to get sales reports to really understand how well those tenants are doing, because it has a direct impact on our cap rate, because that tenant store sales, if they're doing extremely well, can paint the story of the property being less risky and therefore deserving of a lower cap rate. You also want to see how synergistic that tenant mix is with each other, how those tenants work together, as well as how synergistic that set of tenants are with the community. The more of a match that the tenants are with the community and with each other, you're going to be seeing a high functioning shopping center, which the investors can easily identify when they go visit the property. And if it's working really well, it's going to yield you a lower cap rate. And as a team, you're talking amongst yourself and trying to figure out, can I justify a 2x of the NOI? Can I justify increasing your occupancy level from 80% to 100% in 12 months? And as an investor of the property and as an operator of the property, you're trying to figure out, how can you 2x that NOI? How can you do it? Is it that you have to do a complete makeover of the property to bring it from a Class B to a Class A property in terms of the way that it looks and the way that it flows? Is it expanding the property itself, adding out parcels, building more gross leasable area? Is it a completely different tenant mix at the property that just functions together much better holistically, that it functions way better altogether? The question is, why would a tenant agree to pay more rent at your property? What are you going to be doing differently to justify that rental increase? And ultimately those rent increases have to be justified by the tenant sales, because if the tenant's sales are $200 per square foot and you try to increase their rent from $20 a foot to $40, they're going to go out of business. However, if you are able to find out which tenants can generate $1,000 a square foot in your property, then you can easily make the case for bringing your rents from $20 a foot to $40 a foot. And to bring in a tenant that is generating $1,000 a foot in sales is not an easy feat, because there might be certain things that have to take place at your property for them to be allowed to do that. Maybe it's additional parking. Maybe it just has to look a certain way so that their customers are flocking to it. Maybe there needs to be certain co-tenants that they really thrive off of. Like Lululemon might really thrive off of being next to LA Fitness, for example. Just remember that commercial real estate isn't all about spreadsheets and offering memorandums. It's about knowing your product, knowing the neighborhoods, being in the community, looking around, driving around, seeing what's out there. It's on the ground. I always say that commercial real estate is a contact sport. You need to build relationships with brokers, with investors, with the tenants themselves, even with vendors. It's operations, it's leasing, it's acquisitions, it's asset management, it's accounting. It is all of that. So for you to be the best in commercial real estate, just know that you want to try to master as much of it as possible. I hope you enjoyed. If there's something that you disagree with or you think I missed, or another topic that you want me to speak about, please drop a comment below. Also, I am a micro YouTube channel right now. I have about 300 or so subscribers. Please hit subscribe to try to get me to at least 1,000 within the next couple of months. I really appreciate it. And I'll see you next time.